Hi everyone. Welcome back to the new video where we are going to kickstart with forecasting relevant line items. The first line item is going to be revenue forecast. In row number 6, what do we find? We find a total revenue, which is a total value, which is a summarized kind of a fashion. We also have a detailed description of the revenue when we look at the row number uh, from 113 to 124, right? Until this point of time, we have got the historical data for balance sheet, income statement, and cash flow statement, and we have also regrouped them. So in this video, we are going to work around with forecasting all the relevant line items. Which all line items we are going to forecast? For our information, we would be forecasting revenue coming from India, revenue coming from international market, other operating revenue, and gross sales in value. So these are going to be the major important element within the revenue segment. Now, to forecast this revenue, we will also use input and calculation sheet. And we would be using this input and calculation sheet. Before we start forecasting that, we are going to rename this file as file number 14. So let's name this file number 14, FinMod Britannia Revenue Forecasting. Or we can say just forecast. Now, in this input and calculation sheet, we come to row number 18 and we select the array, which is row number 18, and we change the cell style to header. And in cell number A18, we write input T. Similarly, we scroll down within the same sheet and come up to row number 50. I select the row, change it to header, come to cell number A50 and write calculation. So basically in this step, so basically in this, from this step, we are going to start using the ICO framework, input, calculation, and output framework of financial modeling. To understand how this forecasting is going to work, let's look here. Now, when you look at this two particular table, which is in this segment and the other one is into this segment, these two are just kind of a replica of a sheet, which is input and calculation sheet, and this is IS sheet. As of now, our revenue, which we are supposed to forecast, are somewhere over here, are actually calculated revenue where the normalized income statement is there, is somewhere in row number 6 of income statement, and the details are somewhere between 115 to 125 row number within the income sheet. So what do we have? We have data in this section, which is for the historic period. As you can see, the structure for these periods are historic, and this is where we are going to look out for the forecast data. So what is going to happen? So we are going to work around with this historical data. The step number 1 is going to be getting this historical data, everything from income statement and getting under this calculation area. So basically what we are going to do, we are going to link them. Okay, we are going to link them. So this is going to be interconnected. So this becomes our step number 1. And that's where we will also have a bifurcation like given as revenue, India, international, and whatever all the details for all the line items which we are going to forecast under calculation. So this becomes step number 1. The step number 2 is going to be identifying using this historical data and identifying the basis of the forecast. So for revenue, probably we would use year on year growth rate, year on year growth rate. And when we are going to start forecasting respective line item, I am going to inform you that what would be the basis of forecast for the respective line items. So year on year growth rate will be calculated at input timeline. So we would have something called as percentage of something, or maybe using some ratios, and it could be multiple things. In this case, like year on year could be what was the growth rate compared to the previous year. So this becomes our step number 2. What would be our step number 3 in this case? The step number 3 would be forecasting that growth rate for the future financial years. So that would be using this historical basis data and also utilizing your own qualitative understanding of the financials of the company and forecasting what is likely going to happen on the forecast years. And that would be your step number 3. And using the step number 3 data, which is what would be the growth rate for the forecast years, we are going to forecast, get the exact values, what is likely going to be the forecasted value. So let's take an example in this case. Let me change this number just for the sake of discussion. So let's say that we have 100 of revenue here and 110 of here. So of course, we'll get a growth rate of 10%. So similarly, we will get some historical data for the growth rate. And let's say by using this historical data, we identified that the forecast for the first financial year, for the first forecast year, is going to be 8%. Subsequently, it is going to be 10%. Then how it will help? 8% is going to help us to calculate the forecasted value for revenue. It is going to use the last historic data, and that's where we are going to compound that value. So imagine that if this is 125, so 125 multiplied by 1.08, which is 108% of 125 will be the forecasted value. And that's where the step number 4 is going to be, where we get actually the forecasted values. And once we have this forecasted values in the calculation area, which is calculated, that's where step number 5 is going to work around, which is going to get linked at this segment. So this becomes our step number 5. And if required, it needs to be linked to actually the normalized area as well. So right now, if we look at our connection within the income statement, the row of 120, 120, where the details of revenues are there, the total sales of revenue are actually connected to the row number 6 values line items, which is going to be step number 6. So just quickly, step number 1 is going to be linking the historical data and bringing them to the calculation area. Step number 2 would be using the basis, like identifying what would be the basis of forecast. So probably year-on-year growth, some ratios, some multiples. And then step number 3 would be forecasting what could be those ratios, what could be the growth rate, what could be those multiples could is going to be for the future forecast years. Step number 4 would be using those ratios, growth rate, and everything, and forecasting the relevant line item for the forecast year. And finally, once we have got that forecasted values, that needs to be linked, basically, that needs to go to the right place within the financial models, which is the 3 statement model. I hope this gives you a sense of what exactly we would be doing. Let's come to the income statement. So step number 1 is going to be working around with this one. So let me just copy this 2 element, which is going to be India and others, international. So I copy this 2 and I come to input and calculation. And then within this area, we are going to have the data. So I come to cell number C53 and paste special as link. So exactly whatever is written in that cell, which is in cell number C114 in income statement, is going to come in input and calculation cell number C53. I come to cell number B52 and select this array and give a header, which is going to be heading 3, and write revenue. I scroll down and I have got this India and others international. I come back to income statement. I select this array, which is the historical data. I copy this segment. I go back to input and calculation. I come to cell number G53, paste special as link. So this is where we have the historical data for India and others international. Now, as we said, this is step number 1. Step number 2 would be using the historical information and identifying what would be the basis. In this case, the basis is going to be year-on-year growth. So let's come to cell number B20 and we write revenue. I select this cell and change it to heading 4. I come to cell number C21 I write India, I write others. I can also link that from the cell where we have these values, where we have this text. I can actually link them from the calculation area. Now I write year on year growth for India. So can we do a calculation in cell number G21 for March 22? Actually, for that, we need to have revenue coming from India for March 21, but we don't have. So again, that's why this is going to be left out as a blank. And here we are going to create a new cell style, which is going to be called as blank cell. I come to my cell style. I go to this area, which is new cell style. I change this as blank cell. I come to format, I don't touch anything. I come to fill segment and I just give a light gray color. So this is what the sample is. So I press OK, I press OK. And when I look at my cell style, I have a blank cell. So this is my blank cell. Now I come to cell number, this one, which is cell number H21. Can we have the year-on-year growth in cell number H21? That is for March 25. This is for March 23. Yes, we can have that. So the value is going to be the formula is going to be H53 divided by G53 minus 1, and I press enter. So what do we find? We find something in decimals. So we want to change this into percentage. So we will also have something which is going to be in percentage. So we create a cell style, new cell style, percent, new, because we already have something called as percent. We uncheck everything. We only select this. We come to format. We come to number. We come to custom. And we press OK. We press OK once again. When I go to my cell style, I have something new cell style, which is percentage new. I select that. Now, one thing, if I just use 0, you can see what the difference it makes, which gives us that dash dash in percentage. Getting back my values and calculating the same values for all the historic years. And here we have, which is 14.5, 2.8, 5.9%. I come to my this cell, which is going to be my forecast years. And this is where the actual work is going to begin. What do we find? We find for the historical period, it has 14.5, 2.8, 5.9. And let's say for my average, I'm forecasting that the growth rate is going to be average of what has happened for the last 3 years. So I change this, I use a function called as average. I change the cell style to percentage. Now I give the user of this model as a choice to edit this cell. I don't want the user to edit these cells because these are factual information. But yes, the user can edit this cell. So for that, we are going to create one more cell style, which is going to be called as optional input. We come to new cell style. We write here optional input. We uncheck everything. Apart from fill or no shading, we come over here. We go to fill and we select a light shade of blue or something like this. So blue goes. So we are keeping this as OK. So fill is shaded. Press OK and I change this to optional input. Now this is where we are going to forecast it. Now what I am assuming is that the growth rate, which is 7.7, which is estimated for March 26, I'm estimating that these are going to slow down and this is that growth rate is going to fall up to 5%, let us say. That's what my forecast is. So I just hard code this 5% and change the cell style to like 5%, and I change the cell style to input as well. So this is going to be my input cell. So what I'm saying is that 7.7% growth rate for March 26 is going to be there for March 26, and gradually that growth rate is going to fall in a linear line in such a way that by March 31 it comes down to 5%. So basically I need to have a number which should be dynamic, so that if I change my optional input or my input value, the values should also be adjusted. I cannot just use a simple formula which is going to be this minus this, or and then again dividing it with some numbers. So what we are going to do, look at this function. So this is going to be the previous cell, which is 7 K21 minus, I start a bracket, and again once again I select this K21 minus, I select this cell and I only freeze column P. I close the bracket, I divide, again start my value. So basically I need to have those time intervals. So I select this P2 and freeze it completely. So $P2, $P$2 minus just the column counter for previous cell. So K2 in this case. And I make sure to freeze only the row number, not the column number. So K$2, I close the bracket and I press enter. I change the format to percent and also to optional input. And when I copy this formula to right, you can see this percentage or the growth rate is gradually going down. One good thing about this is that if I write just 10%, you can see it have 9876. If I change this number, let's say to 15, it automatically adjusts the values. And when I try to just use a line, let us say uh, something like this, you're going to find that this line is always going to work. So let me bring this back to average, what it had, and getting this back to 5%, every time you are going to find this linear line. Of course, we can have a debate that whether whether these growth rates are going to be linear or not. But yes, this could be one of the ways where you can actually streamline, smooth out your forecasting elements. Now, this is basically the step number 3 of what we had talked, which is using the historical information and for forecast years. Step number 4 is going to be using these information and forecasting the relevant line items. So we come down to the revenue segment within the calculation, which is for India. And this is the cell or column where we are going to start forecasting the revenue coming from India. What will be the formula? Since we are using a growth rate for in input timelines, so this is how the formula is going to work, which is J53. So the previous historic revenue multiplied by the forecasted growth rate. In this case, 7.7%. Closing the bracket, which is K21, and pressing it enter, copying this formula to right. And here we have the forecasted revenue coming from India. Now, one more thing, the last thing which we need to do is we need to create a cell style which give information to the user. Yes, this is where after this cell, the formulas are getting changed. So basically, when I try to look at the formula, these all are coming from income statement. Whereas this formula is actually, these values are actually coming within the sheet. So what do? We create a new cell style, which is going to be called deviant, and we are going to mark it in this cell, which is cell number J53. Let's go to our cell style. We create a new cell style. This is going to act as deviant. And this time we uncheck everything apart from borders and no shading. Fill. So fill, we are having something a bit darker. So let's say that we are keeping this, let's say keep this, let's keep this. And then we go to borders and we are filling this. And of course, if you want, we can also change the color of the text as well, but let's keep the text color consistent, majorly consistent with dark. So fill is green with border, and I'm pressing it OK, and we have deviant OK. Cell style, we have a deviant cell style. And the moment I press it, it gives a kind of a, it acts as a highlighter in this sheet, right? Why? Because this clearly shows that something is happening in the sheet just after this. Something is happening within this row just after this cell. Okay, now let's work with forecasting this others international. Now at this point where we are, we have forecasted up to this point, which is point number 4. Point number 5 is going to getting this data to actually this particular element, which is actually getting this forecasted or calculated line items to the reported segment, which is going to be our income statement in this case. Coming back to the input, now we have this others international. We are going to be relatively quick with this case. We go up, we come down. Again, we are going to use the same process. We change the cell style is to custom blank cell for cell number G22. We come to H22. The formula goes like this, equals to H54 divided by G54 minus 1. Changing the cell style to percent %new, calculating the forecasted growth rate for others. And then again, let's use a average growth for the last 3 years. We can see the growth was pretty strong in financial year 23-24. It is it has taken a kind of a bump in March 25. Again, we are hoping it to be average and keeping this as this format, which is going to be 13.1%. We come to cell number P22. We change this to input format and we hard code 6% and change the cell style to percent. We copy simply this formula, and that's what the beauty was while while we were constructing this formula, that I can copy it and paste it anywhere and it is going to refer to the right cells. So again, this is how we are getting, which is for March 26, the growth rate is expected to be 13.1%, and we are expecting that this growth rate will slow down to 6%. So here we have, which is 6%. For others international, we come down and we start forecasting for the revenue line items. We start forecasting revenue coming from others or international business. So for cell number K54, J54 into 1 plus K22. And here we have cell number J54 will have a cell style of deviant. Now we copy this element, which is going to be from cell number J53 to P54. I come to our IS sheet, come to cell number K14 in IS and paste special as link. And once again, I change the cell style for J114 and 115 to deviant. Just again to make sure that the values or maybe like something is changing in these sales just after this. So the moment we link this, one thing which we can be pretty sure is that total sales of goods which has been forecasted is complete at this point, which is for K118. I change this and I hold it up to this point. Let's continue from where we have left. until this point, we have extracted two line items within the revenue segment. So when we look at cell number K6, and if I try to look where the data is coming, it links to K118. If I go down, the K118 is basically the total operating revenue, right? Which includes the other operating revenue. Of course, we are also going to calculate the gross sales value. So let's work around to forecast the other operating revenues. What we are going to do, I copy this segment. I come to input and calculation. I come to cell number, actually C56, and paste special as link. I've left this on purpose. Why? Let me show you. So this cell C55 is going to be total sales of goods, which is going to be TSOG, and we change the cell style to subtotal. We come to cell number C57 and we say this is total operating revenue. And again, we change the cell style to subtotal for the row. We come to cell number G55, which is basically the total of revenue coming from India and others section. The formula is consistent across all the financial years. For total operating revenue, the formula is basically total sales of goods plus other operating revenue. So sum of row number 55 and 56. And let's get the historical data for other operating revenues for income statement. I select the array G117 to J117. I come back to input and calculation sheet in cell number G56. I paste special as link. I paste special as link. Now I am going to work around with the basis, which is in this section, other operating revenue. This is going to be the percentage of total sales of goods. So in cell number G23, we'll have a formula of the other operating revenue divided by the total sales of goods calculated for the same year. Changing the cell style for G23 to percentage new, copying the formula to write for all the historic years. I come to cell number K23, use average function for all the historic years. What do I get? I get 1.8% approximately. I change this to optional input, making sure this is in percentage format, which it is. Coming to cell number P23, cell style to input and percentage. Keep this as 2% and filling this with the same formula as we had done for the previous cases. Control D and Control R. So the formulas has been filled. Now, using these ratios, which is basically the forecasted estimates and forecast, we are going to calculate the other operating revenue. We come to cell number K56 and the formula goes like this: calculated or forecasted total sales of goods multiplied by the ratio. Control R. And when we look at the data, here we have the total operating revenue. The final step, copying this forecasted area. Let's give the deviant first. So deviant for the historic years. Copying the section which is cell number K56 to P56. Coming to income statement and coming to cell number K117. Linking it, paste special as link. Changing the cell style for J117 back to deviant. And we can see the changes happening in the total revenue values. And of course, that has also been changed in cell number K6 as well. right? So in this row also we have got the respective values. Coming back, we are also going to forecast the gross sale values. So I copy this, I come to cell number C59, paste special as link. I come back to income statement, I get all the historical data, copy, come back to input calculations, under calculation, cell number G59, paste special as link, got the historical data. Let's go for the basis. So gross sales value. So this is again going to be percentage of total sales of goods. Yes, this is net sales. We are using that as a basis. So for cell number G24, the formula is going to be the gross sales value G59 divided by G55. Tab. I come back to cell number G24, change it to percentage format and copy the formula to all the historic years. What we can see is that the gross sale value is about 104.5%, or maybe we can say 104 to 105 to 105.2 kind of a range. So somewhere it is falling on that range. We come to the cell number K24. We use a average function for getting the historic average for the percentage of TSOG, which is giving us 104.90, which looks possible. Change the format to optional input. It already has percentage, so we are not touching that. Coming to cell number P24, changing the cell style to input and to percentage, changing this to 103%. Coming to the other areas, which is the forecast years in between, copying the formula, pasting in cell number L24, copying the same formula and pasting it to all the uh, left out forecast years, which are in March 27 to March 30. So here we have the multiples or the ratios, and using that we are going to calculate what is the forecasted gross sales value for 26 to from 26 to 31. Let's come down in cell number K59. The formula goes like this, which is equals to K55 multiplied by the K24. We press enter, we get the value to be 19,875.1. We change the cell style of J59 to deviant. We select this array, which is from K59 to P59, and I use Control R as a function. So again, this is how the calculation is happening for the forecast years. I select this array because we have calculated gross sales value. I come to income statement. I come to cell number K120, pay special as link, and come back to cell number J120 and change the cell style to deviant. If you want, we can also have that net sales value. We already know what the net sales value is going to be. So basically, the net sales value is going to be matching with the total sales of value. If you want, we can also just have that completion. So I can just use this function and use cell number K124 is going to be equals to K116, and using it Control R, copying the format, selecting this array and pasting special as only formats. So this one is formats, press OK. So here we have. So now these are actually linked with the above values. We can understand that the difference between the gross sale value and sale of goods are going to be part of stock returns and discounts, promotion and channel. Since we are not forecasting these line items, so it is irrelevant for us to fill these cells. So this marks the completion of the forecast of revenue. Thank you for watching.